My name is Arjun Ramakrishnan, and I am from Lake Oswego High School in Lake Oswego, Oregon. I'd like to begin by thanking the Young Investors Society for the opportunity to present Microsoft Corporation. Microsoft Corporation, ticker symbol MSFT, is listed on the NASDAQ stock exchange. The sector that they are in is technology, and the industry is software infrastructure. Based on my analysis of this company, I've come up with a buy recommendation. The current price as of January 9th, 2024 is $375.79, and the target price within the next 12 months is $500.32, which is a 33% increase. I've also included sensitivity analysis and came up with a 3% decline in the conservative case and a 48% increase in the aggressive case. Additionally, I used the dividend discount model to value Microsoft and resulted in a $471.72 stock price, which is a 26% increase. Speaking about the business, almost everyone has heard about Microsoft from some point, and they have strong brand recognition. They were founded in 1975, and they develop and support software services and devices and solutions that deliver new value for customers and help people and businesses realize their full potential. Microsoft has a wide range of services, from cloud-based solutions to CRMs to talent management solutions to gaming services to hardware devices and even online advertising for global audiences. So let's move into a more detailed overview of Microsoft's different segments or industries. So broadly, all of Microsoft's wide range of services can be put into three main buckets of business. These three buckets are productivity and business processes, intelligent cloud, and personal computing. Each of these segments has a forecasted growth rate. The productivity and business processes segment is projected to grow at 15.34% compounded annual growth rate. Intelligent cloud has a 16.4% compounded annual growth rate, and personal computing has a 3.2% compounded annual growth rate. The reason for this high growth rate is because Microsoft is at a position where it can strategically integrate into its systems or is planning to integrate into its systems in the intelligent cloud segment and the productivity business segment, AI. Let's take a look at competitive positioning. I used the model of Porter's 5 forces. Based on this, I concluded that competitive rivalry is a strong force with a 5 for Microsoft because competitors like Google and Amazon are actively attempting to increase their market share. However, on the other end of the spectrum, there are lower forces such as buyer power and threat of substitutes. This is because once a consumer starts using Microsoft products like Office and Azure, it is an incredibly high cost to switch. Microsoft has a strong force of stickiness to it and high branding. Additionally, there's a high cost to retain users as well, to retrain users as well. The remainder of the forces, such as supplier power and threat of new entrants, are moderate. Looking at competitive forces from a moat analysis perspective, historically, Microsoft has been a strong leader since the early 1980s with products like MS-DOS, Windows, SQL Server, and etc. In the present, they have a strong balance sheet and a historically high revenue and a high cash and cash equivalents. They have a consistent track record of dividend payments with approximately $3 annually, and in the future, strategic investments by Microsoft in intelligent cloud, AI, Activision Blizzard, and etc. empower them for a prosperous outlook. Additionally, they have a tight integration of AI with Office and Azure that will help them grow their business in the future. Let's look at it from an investment perspective. Microsoft provides products and services related to high-tech software, cloud computing, and AI. Additionally, they have high levels of cash on their balance sheet, which can facilitate a stock buyback or a strategic acquisition. Or additionally, they can pay more in dividends, which looks great for investors. Recent market conditions produce a unique buy opportunity for Microsoft. Based on my DCF model, the enterprise value per share is $500.32 in the expected projections. In the dividend discount model, I arrived at a $471.72 expected price per share. Over the next 5 slides, I'll be walking through the calculations of the process by which I arrived at my estimated values. I'll start it from a bottom-up projection of revenues by segment. As I spoke earlier, the productivity and business processes segment was expected to grow at a 16.4% CAGR, and the personal computing segment was supposed to grow at a 3.2% CAGR. From that, I aggregated the expected revenue growth rate over the next 10 years. I projected out the income statement and balance sheet numbers for the next 10 years for all other values except revenue, based on the 5-year historical averages for these values. From these values, I calculated free cash flows to the firm over the next 10 years, as you can see in slide 9. I took those projected numbers for the free cash flows for a year-on-year basis and discounted them back to a present value using an estimated weighted average cost of capital. The calculations for the weighted average cost of capital are on slide number 10, where I've used long-term bond rates, equity market risk premium, unadjusted and adjusted beta, tax rates, and a debt-to-equity ratio to calculate the selected weighted average cost of capital of 7.48%. The calculations for tax rate and cost of debt are also based on historical values for Microsoft and are shown on slide 11. Finally, I used the weighted average cost of capital to discount all the future cash flows back to present values and calculate the terminal value back to present value, and then use those numbers to calculate an equity value per share. And that's what you see in slide 12, and where I arrived at an equity value per share of $500.32. In addition to the DCF, I used the dividend discount model to come up with an estimated price per share. And that's what you can see on slide 14, where I made an estimation of the average dividend growth rate on a quarterly basis based on historical data, annualized it, and then formed an expectation of the next year's dividend payment, which is $3.29. I used that and an annualized return expectation of the S&P 500 to come up with an expected price per share using the dividend discount model of $471.72. I know that was a lot of numbers and information thrown at you very quickly, but if I had to summarize all of that in one statement, I would say that Microsoft has a great upside potential from an investment perspective. Now, let's move on into risks. As you're aware, no one business is completely risk-free. The same is the case with Microsoft. New government regulations or antitrust laws could come in and prevent Microsoft from making strategic acquisitions, market penetration, and things like that. Similarly, federal interest rate increases could have an impact on the weighted average cost of capital, which in turn will have a lowering effect on the enterprise value. There could be a reduction in the rate of adoption of AI technologies. Additionally, Microsoft's price-to-equity ratio is 35. For reference, S&P 500 has a PE ratio of 28. Some of this could be explained by Microsoft's membership in the Magnificent Seven. However, for a firm this big as $2.5 trillion to sustain such a growth rate could be untenable. There is always competition from new entrants as well. High tech is a space that's very lucrative for new entrants who want to cause disruption, and Microsoft is not immune to this. But all said, we also saw that Microsoft has a great moat, strong branding, and a lot of cash on hand to deal with any and all of these circumstances if they were to arise. Over the next few slides, I'll be talking to you about Microsoft's environmental, social, and governance considerations, corporate social responsibility initiatives, and diversity, equity, and inclusion initiatives. Microsoft strives to be carbon negative, water positive, and zero waste by 2030. And they also want to protect and preserve their ecosystems. They will also like to build a planetary computer. From a corporate social responsibility perspective, they have trained over 8.5 million people. They have processed over 65 trillion security signals. They have helped bring high-speed internet to 63 million people in underserved communities. And 550,000 people have been provided access to clean water and sanitation solutions in countries such as Brazil, Indonesia, India, and Mexico. In addition, from a diversity and inclusion standpoint, women now make up 31% of the core Microsoft workforce. Similarly, 55% are racial minorities. And looking at these numbers, you can tell that they really are a company that not only focuses on innovative, high-paced growth, but also focused on bringing the community along with them and taking care of their impact on the planet as they do so. On the impact of AI on Microsoft, it is incredibly clear that Microsoft is at the forefront of leveraging AI technologies. Its investment in OpenAI set it up for success and was one of the most strategic investments that Microsoft could have made back in 2019, it being a combination of cash and Azure infrastructure credits. The initial investment of $1 billion is now valued as high as $29 billion. ChatGPT, as a result of this, ChatGPT will be available as part of Azure OpenAI services, where there's integration with OpenAI, Copilot, and Bing will be powered by OpenAI's DALL-E 2. Excel also now has a ChatGPT function. So, like I said earlier, Microsoft is in the best position and is suited to leverage AI. In summary, my recommendation is a buy based on the price of $375.79 with a target price of $500.32 or a 33% increase. Microsoft is a great business with a wide moat, and their ability to leverage and transform capital at scale is unparalleled. For all these reasons, I believe that Microsoft will be a great investment. With that, I conclude my presentation and would like to thank you for your time and your audience.